Welcome to Section 7 of the ASC 710 training series. This final section covers the audit procedures, internal controls, and compliance checklist an accounting team should have in place to ensure that compensated absences, deferred compensation, and termination benefits are accurately recorded, properly controlled, and audit-ready at every period end. By the end of this section, you will be able to identify the key audit risks associated with each major compensation liability under a SC 710. You will be able to design internal controls that prevent and detect common errors. You will understand the substantive testing procedures auditors apply when examining these balances. You will have a practical compliance checklist you can use at every period end close, and you will recognize the most common audit findings along with the steps to resolve them. The primary audit risks for vacation accrual are completeness and measurement. The most common finding is that the accrued hours per employee are understated, either because the HR system is not reconciled to payroll or because newly hired employees were excluded. A second risk is measurement error, where the current pay rate is used instead of the expected future rate, or where employer payroll taxes are omitted from the calculation. A third risk is that the forfeiture estimate has not been updated based on recent historical data, resulting in a liability that is either too high or too low. For deferred compensation, the primary audit risks are timing, presentation, and completeness of disclosures. The accrual may be booked in the wrong period if the plan terms are misread, or if the allocation method is not tied to the correct service period. The most common presentation error is netting the rabbi trust asset against the deferred compensation liability instead of showing them gross, which auditors treat as a misstatement. Fair value of trust investments must also be updated at period end, and disclosures must explicitly state that rabbi trust assets are subject to creditor claims. For termination benefits, the greatest audit risk is premature recognition. Companies sometimes record a restructuring reserve as soon as management approves the plan internally, before the plan has been communicated to employees, which violates the fourth ASC 420 criterion. For voluntary benefits, the acceptance date must be clearly documented because recognition turns on that date. Once recognized, the restructuring liability must be updated whenever the estimated total changes. Finally, the split between current and non-current must reflect the actual planned payment schedule, not an arbitrary allocation. Effective internal controls for vacation accrual include a monthly reconciliation of employee vacation balances in the HR system to the payroll system to catch discrepancies early. The pay rate assumptions used in the calculation should be reviewed independently at each period end by someone not directly involved in preparing the accrual. The forfeiture estimate should require approval from a manager outside the accounting team. Before close, the final vacation liability should be tied out in detail to the employee roster to confirm it is complete and that no terminated employees have been missed. Controls for deferred compensation should start with an annual review of the plan documents to confirm the terms have not changed in ways that affect the accounting. The method used to allocate the total benefit over the service period must be documented in an accounting policy memo approved by management. The fair value of rabbi trust investments must be updated at each period end by a person with access to the investment statements, and the update should be reviewed and approved. The rabbi trust agreement should be reviewed by legal counsel at least annually to confirm that gross presentation is required under its terms. For termination benefit controls, the most important control is a formal checklist that must be completed before any restructuring liability is recorded. The checklist confirms all four ASC 420 criteria are met and documents the specific date on which the plan was communicated to employees. The restructuring liability must be updated monthly to reflect actual payments made and any revisions to total estimated costs. Recording a restructuring charge should require sign-off from the Chief Financial Officer or Controller, given the materiality and reputational sensitivity of such disclosures. Auditors will perform substantive procedures to test compensation liabilities. For vacation accrual, auditors obtain the employee vacation balance report directly from the HR system and independently recalculate the liability using pay rates pulled from the payroll system. For Rabbi Trust assets, auditors inspect the trust investment statements and agree the fair value to the balance sheet. For restructuring liabilities, auditors request documentation of the plan including board minutes, internal communications, and the written notice provided to employees to confirm the communication date and the content disclosed. A practical period and compliance checklist covers 4 areas. For vacation, confirm that HR balances are reconciled to payroll, pay rates reflect the expected settlement rate, and employer payroll taxes are included in the calculation. For deferred compensation, confirm that plan terms have not changed, the current period accrual has been computed correctly, and the Rabbi Trust fair value is updated. For termination benefits, confirm all ASC 420 criteria are documented before booking any charge. For disclosures, update all note language to reflect current policy terms, current amounts, and any changes since the prior period. Based on common audit findings in practice, 4 corrections come up most frequently. When vacation is understated, the resolution is to implement a monthly reconciliation between the HR and payroll systems to catch the shortfall before period end. When the Rabbi Trust asset and liability are netted, the financial statements must be restated to show both on a gross basis. When a restructuring reserve has been recorded prematurely, the entry must be reversed until all 4 ASC 420 criteria are satisfied. When the creditor exposure of Rabbi Trust assets is not disclosed in the notes, the specific language must be added describing the risk. Let us review the key takeaways from this final section. Audit risk for a SC 710 liability centers on 4 areas: completeness, measurement accuracy, recognition timing, and balance sheet presentation. Controls must specifically address each risk. No restructuring charge should ever be recorded before the 4 ASC 420 criteria are fully documented. The period-end compliance checklist should be run for all compensation categories before close. And the most common audit findings, including understated vacation balances, netted Rabbi Trust presentation, and premature restructuring reserves, are all preventable with consistent controls and monthly reconciliations. Thank you for completing Section 7 on audit procedures, controls, and compliance. This concludes the ASC 710 section training series. Please proceed to the recap video for a consolidated review of all 7 sections.